Well, hello everyone. Wow, it's April already. We're through the first quarter of 2022. Time sure does fly, doesn't it? Well, just to give you a recap of the way things are going, of course, markets continue to be very volatile with all the things going on in Ukraine, with all this currency issues, with how we're trying to put Russia in a box. All this is changing a lot in the global economy. We've even got China and Saudi Arabia negotiating to trade oil in yuan, the Chinese currency. So there's a lot going on right now. Inflation, wow, inflation still is an issue. One thing I read this morning, what I thought was very interesting, is that used car prices are 1.3% on average higher than new. Figure that. Because they always told you to buy a used car and save money, right? Well, right now, used cars are more than new cars on average. If you've been to the grocery store, you see the issue there. I bought some bacon because we regularly eat bacon. It's amazingly expensive. So a lot of stuff going on in the markets with the volatility. Seen a lot of volatility in tech stocks. And with the announcement that Elon Musk is buying a large part of Twitter, and the markets react to that. A lot of the tech people don't like the fact that he might bring free speech back to the Twitter platform. Imagine that. But that's caused a lot of volatility in the tech stocks, which are the NASDAQ stocks. So we're also seeing, and I read recently, that stock buybacks, which is when a company uses its cash to buy its own stock back to get more control, are increasing. They're expecting possibly up to $1 trillion in stock buybacks. And that pushes the market up because it reduces the amount of shares in that particular company available to purchase by the public. It also gives the company more control from all these craziness that's going on in corporate America today. So again, a lot of volatility, a lot of changing economic and even social issues that are really causing the markets to be in a state of flux. When we go to the benchmark currency rating, which is the 10-year Treasury, that's a benchmark that a lot of insurance companies, banks, and corporate America uses to determine how things are going. January 3rd, the 10-year Treasury was 1.63%, and as of yesterday, it's like 2.6, a little over 2.6. Big change there, and that's supporting of things to come, because if 10-year treasuries keep rising, we're going to see downward pressure on the stock market. So there's some strategies we can use that we are using to help that. And we even had an issue where the yield curve flattened, and the Federal Reserve announced they were going to start raising rates. And so when that happened, it caused the yield curve to flatten. And then when they saw what happened, they were like, oh, but we're going to start unwinding the balance sheet, which is the inventory that it keeps, which has grown astronomically, of treasuries and mortgage-backed securities. So that caused the yield curve to get a little back to normal. But what's important to you is our strategy. We're seeing more good corporate bonds come available, and so we're not having to rely so much on bond corporate ETFs. And so we're seeing some pretty decent ones come available. I think what we've really got to look at is our dividend strategy. And if you you're like me, most of you, and you remember commercials from the 80s, and you remember the old Volvo commercial that they're boxy but they're nice, and that was on commercials everywhere. Well, our dividend strategy is kind of the same way. They're boxy, but they're nice. When you look at historical gains and performance over time, dividends have played a massive part of that, and that's our strategy, and that's why we keep talking about the income strategy. So as we put everything together, just remember that. We're looking at this on a daily basis, every hour, really. and trying to come up with the best strategy for the environment we're in. Because you may have a game plan for a good sunny day, but if it starts raining, then that pass is going to have to be changed into a run, and that's what we're looking at right now. A lot of people are saying we may have a 10-year period of flat stock returns. Don't know with all the cultural and economic changes that are happening, but we'll see. What you need to know is that we're looking at it and we're prepared for it. Now, I know everybody, I appreciate your comments and best wishes for Robin. Kind of put us behind in our reviews the first couple months of the year. We're getting that caught up. So if you haven't already been called, you'll be called in the next couple weeks to come in for your beginning of the year review, really to discuss strategy in your specific portfolio and what's going on in your accounts. So wanted to make another announcement. We had some phone issues. We tried a new system, an automated system. I don't know how you are, but I prefer to talk to someone. So we've gone back to using our old team over at Apex to give us live answering and get it directly to us. So you're not having to navigate the voicemail system. And I think that's going to be a real good improvement. So one last thing, there is a link down at the bottom. I was recently interviewed on the Income Generation channel about the strategies we're using, and there's a link in there to watch that. It's not a very long interview, but you may get something out of it. But again, I appreciate all of you. We're just trying to keep you up to date on everything. If you got any questions, of course, you know where to call us. And if you ever wondered why I do what I do, this is one of the big reasons. Can you say hi to everybody, Kelly? Say hi. Say hi. Or you just have stage fright? Okay. Well, we say hi, and we'll talk to you next month if I don't talk to you sooner.